What if I told you that the closest ally of the United States just drew a line in the sand? And this time, it's not politics as usual. What if this isn't just another trade dispute, but the beginning of something that could shake the global economy? For decades, America and Canada stood side by side. Same values, same interests, same system. But now, something feels different. Tensions are rising, words are sharper, decisions are heavier. And the question nobody wants to say out loud is this: are we watching the start of an economic showdown that could change everything? Before we go any further, if you care about global politics, real economic shifts, and clear breakdowns without media noise, make sure you hit like and subscribe to the Maple Doctrine. This channel is where we break down the stories that others rush past. And trust me, what's unfolding right now deserves your attention. For years, the relationship between the United States and Canada has been described as one of the strongest partnerships in modern history, the world's longest peaceful border. Billions in trade moving back and forth every single day. Factories in Michigan relying on parts from Ontario. Energy flowing from Alberta into American homes. Families, businesses, and entire industries connected across that border like threads in the same fabric. But lately, that fabric has started to stretch. It didn't happen overnight. It started with trade disagreements, tariffs, negotiation breakdowns, public statements that felt more like warnings than diplomacy. When economic pressure becomes political leverage, alliances begin to feel transactional. And when leaders start prioritizing domestic strength over international harmony, friction becomes inevitable. From Washington's perspective, the argument has been simple. America must protect its industries, manufacturing jobs, steel, auto production, and national supply chains. Too much reliance on foreign partners, even friendly ones, creates vulnerability. And when America shifts toward economic nationalism, the ripple effects are immediate. But from Ottawa's perspective, the story sounds very different. Canada sees itself as a reliable partner, not a threat. When tariffs hit Canadian goods, it's not just numbers on a spreadsheet. It's workers, it's factories, it's communities that depend on cross-border trade. And when negotiations stall, Canada has to make a choice, push back or pivot. That pivot is what has people paying attention right now. Instead of simply absorbing economic pressure, Canada has signaled that it may diversify, expand trade relationships elsewhere, strengthen ties with Europe, Asia, and emerging markets, and reduce dependency on the US market. And that shift, even if gradual, carries long-term consequences. Because here's the thing, most headlines won't explain clearly. The US and Canadian economies are deeply integrated. Supply chains cross the border multiple times before a product is finished. Energy grids overlap, agricultural exports intertwine, financial markets respond together. So when political tension escalates, markets listen. Investors don't panic immediately. They watch, analyze tone, and read statements carefully. But uncertainty alone can slow momentum. Businesses hesitate to invest. Companies pause expansion. Markets dislike unpredictability more than almost anything else. And that's why this moment matters. Words like, "we'll go our own way," or "oh, we want to tee back down," echo far beyond press conferences. They shape expectations, move capital, and shift strategies. The global economy is already fragile. Inflation pressures, supply chain adjustments, energy transitions, geopolitical instability. So when two of the world's largest trading partners experience visible tension, it adds weight to an already heavy system. Does that mean collapse? No. But systems evolve, power balances shift, alliances adapt, and countries that move first often shape the next phase of global structure. If Canada successfully expands its trade footprint beyond the United States, it gains leverage. If America doubles down on domestic production, it reshapes its economic identity. Both paths are strategic, both come with risks, and both influence global partners watching closely. Europe is watching, Asia is watching, emerging markets are watching. Because if North America's internal trade dynamic changes, supply chains worldwide must adjust. Shipping patterns shift. Investment flows reroute. Currency markets react. At the Maple Doctrine, we don't chase hype. Structurally, this moment represents tension between economic integration and economic independence. The United States wants secure supply chains. Canada wants diversified trade security. Both goals are logical, but when pursued aggressively at the same time, friction becomes unavoidable. Timing is crucial. The world is redefining trade relationships. Countries are forming new regional partnerships. Energy markets are transitioning toward renewables. Technology supply chains are reorganizing. So a shift between the US and Canada interacts with every other global adjustment underway. Think of it like tectonic plates. Small movements over time create pressure. When enough pressure builds, the shift becomes noticeable. Publicly, both sides emphasize strength. Privately, advisors calculate economic impact. Industry leaders advocate for stability. Farmers, auto manufacturers, and energy companies all want predictability. Businesses operate on margins and certainty, not political emotion. If tariffs rise, costs rise. If negotiations stall, timelines delay. If trust erodes, contracts become cautious. It's not all confrontation. Talks continue. Diplomatic channels remain open. Trade frameworks still exist. The relationship hasn't collapsed, but it's under strain. And strain changes behavior. Investors hedge. Companies diversify suppliers. Governments draft contingency plans. Even consumers feel subtle effects through price fluctuations. The real question isn't whether this is a dramatic war headline. The real question is whether this tension marks the beginning of a structural shift in North American economic alignment. If America becomes more inward-focused and Canada more globally diversified, the long-term shape of trade flows could look very different 5 years from now. Now, this is where the real story begins to unfold. Because what we see on the surface, press conferences, sharp statements, political headlines, that's only the visible layer. The real decisions are happening behind closed doors. Advisors are running numbers. Economists are projecting scenarios. Trade officials are reviewing contingency plans. And in both Washington and Ottawa, one silent question is guiding every move. If this tension continues, who adapts faster and who absorbs more damage? The United States is the largest economy in the world. That alone gives it enormous leverage. The U.S. consumer market is massive. The dollar dominates global trade. When America shifts policy, the world feels it. But Canada is not a minor player. It's one of the most resource-rich and politically stable economies on the planet. It supplies energy, minerals, agricultural products, and critical raw materials that the modern world depends on. That stability attracts long-term investors. Energy may be the most underestimated factor in this entire situation. The United States imports a significant amount of crude oil from Canada. Refineries along the Gulf Coast are designed specifically to process Canadian heavy crude. Pipelines have been built over decades to move energy across the border efficiently. This is not a simple buyer-seller relationship. It's infrastructure-level integration. If economic tension spills into the energy sector, the consequences would be immediate. Fuel prices would respond, markets would respond, and voters would definitely respond. Now imagine if Canada begins accelerating efforts to diversify its energy exports, expanding pipeline access to ports, increasing shipments to Europe or Asia, securing long-term contracts outside the U.S. market. That shift would not happen overnight. It would take years of investment and planning, but even a gradual change can shift the strategic balance. At the same time, the United States is pursuing its own strategy: domestic manufacturing expansion, supply chain independence, reshoring production from overseas. These moves reduce vulnerability, but reshoring is expensive. Labor costs are higher. Infrastructure upgrades take time. During that transition, inefficiencies can raise costs for businesses and consumers. The auto industry illustrates just how complex this integration really is. A vehicle assembled in Michigan might contain parts manufactured in Ontario. Those parts may have crossed the border multiple times before final assembly. If tariffs increase or negotiations stall, costs rise. Companies face tough choices: absorb the cost or pass it to consumers. Either way, economic pressure builds. Financial markets react not only to what happens, but to what might happen. Investors analyze language, look for signs of escalation or compromise, and even uncertainty alone can slow investment. Companies hesitate before expanding factories. Corporations delay hiring plans. Markets do not like unpredictability. And this is not happening in a calm global environment. The world economy is already adjusting to inflation pressures, shifting supply chains, energy transitions, and geopolitical tensions. So when two deeply connected economies experience strain, it adds weight to an already delicate system. Another critical layer is global perception. When other countries observe tension between the United States and Canada, they adjust strategies. Europe may strengthen trade ties with Canada. Asian economies may negotiate longer-term supply agreements. Emerging markets may see opportunities in diversification. Global trade flows are dynamic, and they adapt to pressure points. Technology is quietly affected as well. Advanced manufacturing, AI infrastructure, and semiconductor supply chains depend on coordination and regulatory alignment. If political friction slows cooperation, innovation partnerships become cautious. Companies prioritize stability when planning billion-dollar investments. At the Maple Doctrine, we focus on structure over noise. Structurally, we are seeing a broader shift in how countries think about economic security. For decades, globalization emphasized efficiency and interdependence. Now, national security and supply chain resilience are taking priority. Strategic autonomy is becoming central. Both the United States and Canada are navigating that shift. America wants secure domestic production. Canada wants diversified global access. Both goals are logical, but when both sides push assertively at the same time, friction becomes inevitable. Timing makes this even more significant. Trade alliances are being re-examined. Energy systems are transitioning. Regional partnerships are strengthening. Even a moderate shift between the US and Canada could influence broader global patterns. Businesses are already preparing for multiple scenarios. Some explore alternative suppliers. Others review logistics networks. Financial institutions adjust risk assessments. Governments draft policy responses. This is how modern economies respond to uncertainty. Quietly, strategically, incrementally. History shows the U.S.-Canada relationship has faced disputes before. Lumber disagreements, agricultural quotas, steel tariffs. Tension rose, negotiations followed, and compromise emerged. But today's environment feels different because global fragmentation is increasing. Public sentiment has also shifted. Voters support economic nationalism when domestic jobs are at risk, making negotiations more complex. Flexibility decreases when domestic audiences demand strength. Complete economic separation is highly unlikely. Integration is too deep. Infrastructure, supply chains, energy grids cannot be undone quickly without significant cost. What is more realistic is partial realignment, gradual diversification, strategic adjustments, rebalancing dependency levels. Over time, this reshapes leverage and negotiation dynamics. Imagine 5 years from now, if Canada expands trade relationships globally and reduces reliance on the U.S., it gains strategic flexibility. If the U.S. strengthens domestic manufacturing and reduces import vulnerability, it also gains independence. Both countries could emerge more self-reliant but less intertwined. That changes the psychology of the relationship. Interdependence creates mutual caution. Reduced dependency creates negotiation toughness. Or cooler heads prevail, negotiations stabilize. Tariffs are revised, a stronger, updated trade framework emerges. North America remains one of the most powerful economic regions in the world. Markets are watching. Business leaders are calculating risk. Policymakers weigh political gains against long-term stability. Ordinary citizens monitor prices, job markets, and economic signals. And in part 3, we bring this down to the ground level. How all of this tension actually affects everyday Americans and Canadians. So now, let's bring this closer to home. Because while political statements, tariffs, and international strategy make headlines, the real impact eventually lands on ordinary Americans and Canadians. Prices at the grocery store, gas at the pump, jobs in factories and offices, families making decisions about whether to move, expand, or invest. This is where strategy meets reality, and where every citizen feels the ripple effect of high-level decisions. If tensions continue to escalate, certain sectors will notice first. The auto industry, for instance, is incredibly sensitive. Assembly plants and part suppliers rely on seamless cross-border trade. Even minor disruptions can create production delays and higher costs. Those costs inevitably trickle down to consumers. Canadian farmers exporting to the U.S. might face similar challenges, and energy markets could respond almost instantly. Gasoline, heating oil, electricity. Everyday essentials fluctuate based on how negotiations proceed. At the Maple Doctrine, we like to stress that understanding these dynamics early is key. This isn't panic, it's preparation. Watching economic indicators, paying attention to political statements, and noticing market reactions can give insight into potential future outcomes. Right now, we are at a pivotal moment where choices made by leaders in Washington and Ottawa could subtly but significantly shape the economic landscape for the next several years. The silver lining is that neither country is acting recklessly. Both are highly aware of the risks. Even as strong rhetoric dominates headlines, behind the scenes, teams are working to maintain stability. Economists, industry leaders, and policymakers are balancing the need to protect domestic interests with the risk of creating unnecessary disruption. This careful balancing act explains why, despite all the tension, full-scale economic collapse is unlikely. Instead, we are seeing a recalibration, a restructuring of priorities and relationships that could ultimately make both nations stronger if managed correctly. But while the big picture matters, day-to-day reality is influenced by small but meaningful decisions. Consumers may see price changes, businesses may adjust supply chains, investors may hedge or reposition capital, and political leaders will continue to weigh public sentiment. No government can ignore voters and stakeholders for long. The interplay of policy, economics, and public perception makes this period particularly delicate. Another factor is global response. Other nations are observing North America closely. European and Asian markets consider how to adjust trade strategies. Emerging economies look for opportunities where dependencies shift. Even slight changes in U.S. to Canada trade flows can have outsized effects on global supply chains, particularly in energy, technology, and manufacturing sectors. This interconnectedness is why analysts say that while this is a North American story, the consequences are truly global. For viewers at home, patience and context matter. Headlines are designed to grab attention, but the full picture is nuanced. Strong words and bold actions make news, but underlying forces are slower moving, more strategic, and far more complex. Watching how both nations adapt over time provides a clearer understanding than reacting to immediate drama. So what should you look for? Watch policy announcements carefully. Monitor tariff adjustments. Follow energy exports. Keep an eye on manufacturing output, trade balances, and currency movements. These indicators provide clues about the trajectory of U.S.-Canada relations and their economic impact. For anyone invested in North American markets, directly or indirectly, these signals are invaluable. At the same time, the story is also about opportunity. Shifts in trade and economic alignment create openings for businesses that can adapt. Companies that diversify suppliers or markets may benefit from changing dynamics. Investors who recognize early patterns can strategically position themselves. And countries that strengthen economic resilience will emerge stronger in the long run. Change brings challenges, but also potential rewards. As we draw this story to a close, remember that the U.S.-Canada relationship is far from broken. It is evolving. The tension we are witnessing is part of a natural recalibration in a world where economic security and national priorities are increasingly complex. What we are seeing is not the end of partnership, it is an adjustment period. The countries that navigate it thoughtfully will shape the next chapter of North American economic power. And here's the key takeaway. This is not just news. It is a lesson in strategy, adaptation, and long-term thinking. Watching these developments with awareness, understanding underlying structures, and learning from the choices made by both nations gives any observer a huge advantage in interpreting future global events. If you've been following along with the Maple Doctrine, now is the perfect time to take action in the comment section. Let us know what you think. Will Canada successfully diversify its economy? Will the United States strengthen domestic production without losing trading leverage? How do you see this affecting your life, your community, or your business? And if this breakdown helped you understand the story in a way other channels haven't, make sure to share it with friends, family, and anyone who needs to see the bigger picture. Every like, comment, and share helps more people get clarity instead of panic. It also helps the Maple Doctrine continue creating deep, thoughtful analysis you can trust. To summarize, the US and Canada showdown is not a sudden disaster. It's a strategic tension with far-reaching implications. It's about leverage, adaptation, and foresight. Headlines may scream war or collapse, but the reality is a careful, ongoing negotiation, one that will define North America's economic path for years to come. Now let's step back and look at the bigger picture. After examining tensions, behind-the-scenes strategies, and ground-level impacts, the real story is about the long-term shape of North America's economic future. One scenario is partial realignment. Canada could successfully diversify its trade relationships globally, reducing reliance on the U.S. market. This would give Canada strategic flexibility, strengthen its negotiating power, and protect its economy from unilateral decisions across the border. Meanwhile, the United States could continue expanding domestic manufacturing, reshoring production, and securing supply chains. Both countries gain independence, but the relationship becomes less intertwined, a shift that changes leverage, negotiation dynamics, and economic psychology. Another scenario is stabilization through compromise. Cooler heads may prevail, negotiations could stabilize, tariffs might be revised, and an updated trade framework could emerge. In this case, North America maintains its position as one of the most powerful economic regions in the world, with mutual interdependence intact, but modernized to reflect current realities. Either way, timing is critical. The world is already in flux. Energy markets are transitioning, technology supply chains are being reorganized for security, regional trade partnerships are strengthening, and inflation and geopolitical pressures are reshaping global economic priorities. Any shift between the US and Canada interacts with these broader trends, amplifying its significance. For everyday citizens, the lesson is simple. Leverage knowledge and awareness. Monitor tariffs, manufacturing output, energy exports, and currency movements. Watch policy announcements. Observe market reactions. These indicators reveal patterns long before headlines capture the drama. Being informed allows businesses, investors, and families to anticipate challenges and seize opportunities. For governments, the lesson is about balance. Protect domestic interests without undermining strategic alliances. Navigate public sentiment while avoiding unnecessary disruption. The countries that manage this balance will define North America's economic trajectory for decades. The global perspective matters too. Europe, Asia, and emerging markets are watching. They will adjust trade, energy, and technology strategies based on North American dynamics. Countries that position themselves early in response to this tension could gain significant advantages. At the Maple Doctrine, we see this moment as a strategic case study, a lesson in adaptation, foresight, and long-term thinking. It's not about panic, it's about understanding the mechanisms that drive economic power. Key takeaways for viewers: this is not sudden collapse, it's a structural shift. Integration and interdependence remain strong, but strategic autonomy is rising. Market signals, policy decisions, and energy flows are the most reliable indicators of change. Knowledge and preparedness are tools for navigating uncertainty and finding opportunity. The US-Canada relationship is evolving, and those who watch carefully will understand how economic power, trade, and diplomacy intersect. The countries that adapt wisely will emerge stronger, while those that miscalculate could face setbacks. So keep watching, keep learning, and think strategically. This isn't just about headlines or dramatic media narratives. It is about understanding the forces shaping North America and the global economy for years to come. Now it's your turn. Comment, share, and discuss. How do you see this playing out? Which scenario do you think is most likely? And what would it mean for your life, your business, or your investments? Because in times of tension, knowledge, perspective, and foresight are the most valuable tools we have. And this story is far from over.